Imagine waking up one morning and seeing the entire crypto market on fire. Billions, gone overnight. Bitcoin crashing, altcoins evaporating, and chaos spreading faster than anyone could refresh their trading app. But here's the question that shook the entire industry. Who got wiped out? Just one announcement from Donald Trump about new China tariffs. And within hours, more than $19 billion in crypto bets vanished. Some call it the biggest one-day sell-off in crypto history. But was it just bad luck? Or a perfectly timed financial earthquake triggered by the powerful few? Behind the screens, trading bots went wild, markets froze, and algorithms started selling automatically, turning panic into destruction. Millions of traders were liquidated. Yet, strangely, no one could find the whale responsible. Was it a single giant player who blew up? Or was it something much bigger? A hidden system designed to make ordinary investors lose while others quietly profited. Today, we'll uncover the real story behind the crypto crash that nobody saw coming. How one weekend changed everything, and what it reveals about the dangerous game being played behind your screen. It all started with a single announcement, one speech from Donald Trump. And within hours, the entire crypto market went into freefall. It was supposed to be a quiet weekend. Traders were asleep, markets were calm, and Bitcoin was holding steady. But late that night, Trump announced new severe tariffs on China. And just like that, a domino effect began. At first, it didn't look like a big deal. Tariffs? We've seen that before. But what no one realized was that this time, the timing was deadly. The announcement came right after the U.S. markets had closed, when liquidity was at its lowest, and traders across Asia and Europe were still waking up. That gap, that tiny window of silence, became the perfect storm. Because in crypto, markets never sleep, and when prices start to fall, algorithms don't panic, they sell. Within minutes, the first wave hit. Bitcoin dipped, then crashed. Ethereum followed. And altcoins? They were wiped out. By sunrise, $19 billion in leveraged positions had vanished. More than 1.6 million traders were liquidated in just a few hours. People stared at their screens in disbelief. It wasn't just numbers falling, it was dreams collapsing in real time. But here's the crazy part. No one could tell who started it. Some thought a giant whale had dumped their holdings. Others blamed the exchanges. But deep down, everyone knew this was bigger than a single trader. Trump's tariff announcement wasn't just a political move. It was a spark dropped into a market soaked in gasoline. Because for months, crypto had been living dangerously, over-leveraged, overconfident, and waiting for a trigger. And when that trigger came, the market did exactly what it was built to do. It destroyed the weak. The irony? Most of the damage didn't even happen in Bitcoin or Ethereum. It was the smaller coins, the altcoins, where the real bloodbath began. Their liquidity was paper thin. Once the crash started, there were no buyers left to catch the fall. The order books dried up and prices nosedived. It was like watching a house of cards collapse, one layer at a time. By the time major traders in New York woke up, it was already too late. The meltdown had gone global, and while everyone scrambled to figure out who caused it, one truth became clear. It wasn't a single whale. It was the system itself, designed to punish those who play without understanding the rules. Because in the modern financial world, a single decision made by a politician on one continent can wipe out billions on another. And that's exactly what happened the night Trump pulled the trigger on China. When the dust settled, the numbers were beyond imagination. $19 billion. Gone. Not stolen, not hacked, just erased in a single night. The crash was so fast, so brutal, that even the most experienced traders didn't have time to react. It was like the market held its breath and then exhaled everything at once. But here's where it gets dark. The real destruction wasn't caused by panic-selling humans. It was caused by machines. See, most crypto traders today don't buy coins the old-fashioned way. They use leverage. That means borrowing money to multiply profits or losses. So imagine this. You invest $1,000, but with 50 times leverage, you're controlling $50,000 worth of crypto. If the market rises just 2%, you win big. But if it falls even 2%, you're wiped out instantly. That night, as prices started dropping, leverage position wall of fire, erasing weeks of gains in seconds. Traders tried logging in to save what was left, but the exchanges froze, websites crashed, orders failed. By the time the platforms came back online, portfolios were empty. And then came the silence. That eerie silence when millions of people around the world stare at their screens, refreshing charts that no longer matter. Some traders lost life savings. Others vanished from social media, ashamed, broken. The market had once again reminded everyone, it doesn't care about your emotions. Experts started calling it the Great Liquidation. Even veteran analysts admitted they'd never seen something this synchronized. Billions in leverage, gone in hours. Millions of dreams, gone in minutes. But there was something even more shocking hiding underneath all that chaos. Something no one was talking about yet. Because while small traders were being destroyed, a handful of institutions were quietly buying the dip. So was this really an accident? Or was it a reset? A well-timed shakeout designed to clean the field before the next rally? Whatever the truth is, one thing's for sure. When $19 billion vanishes overnight, it's not just a crash. It's a message. A message that in the world of crypto, you're never safe. Not even while you sleep. When the markets began to fall, it wasn't panic that moved the prices. It was code. Thousands of algorithms, invisible, tireless, emotionless, started selling everything they could. One command triggered another, and within seconds the market turned into a digital stampede. You see, in crypto, there's no one to call when things go wrong. No banker to stop a sale. No government circuit breaker to pause trading. It's just math. Cold, merciless math. These trading bots follow strict rules. If price drops by a set percentage, sell everything. If liquidity falls, dump even more. No hesitation, no mercy. And this time, those algorithms went into overdrive. Every liquidation triggered another sale. Every sale pushed prices lower. The loop repeated, again and again and again. What should have been a small market correction turned into a self-feeding collapse. Behind the scenes, leveraged traders were the first to fall. Most of them had borrowed huge amounts to multiply their gains, but leverage is a double-edged sword. If the price rises, you win big. If it drops a little, you lose everything. That's exactly what happened. A trader in Singapore posted, "I just lost my house." Another in London tweeted, "My $120,000 account is zero." Stories poured in from around the world. Traders watching helplessly as the auto-sell bots liquidated their positions in milliseconds. Because in the crypto world, when your collateral shrinks, there's no warning call. The system just sells your holdings instantly. And as that storm spread across exchanges, smaller coins, altcoins, got hit the hardest. Their liquidity was thin, their buyers disappeared, the order books went empty. In minutes, coins that were trading at $10 dropped to $3. Some vanished completely. And while the chaos unfolded, exchanges stood by, watching billions vanish, one line of code at a time. Traders screamed on social media, demanding answers. Who's pulling the strings? Is this manipulation or just the system doing its job? But there was no answer. Only one truth remained. The algorithms had taken control. The machines didn't crash the market out of greed or fear. They did it because they were programmed to. And as dawn broke over Asia, one thing became painfully clear. The collapse wasn't human. It was mechanical, predictable, and unstoppable. But while millions were losing their life savings, someone else was watching the bloodbath calmly, ready to make a fortune from the ashes. The question was, who? As Bitcoin and Ethereum tried to hold their ground, the real bloodbath began somewhere else. In the world of altcoins. Coins you'd never heard of. Projects built on promises, not profits. Tiny tokens that lived in the shadows of giants. And that night, the shadows swallowed them whole. It started small. One coin dropped 5%, then another 10%. But soon the floor gave way. Order books emptied out. There were no buyers, only panic. See, altcoins live on thin ice. Their liquidity is fragile and their markets depend on faith. The moment that faith cracked, everything collapsed. On the hyperliquid exchange, the storm turned into a massacre. Billions in long positions vanished as liquidation bots kicked into full force. Within hours, $10 billion in trades were wiped out. Gone, deleted from the digital world like they never existed. Traders couldn't believe what they were seeing. Their dashboards froze, their stop losses didn't trigger, and by the time they refreshed their screens, their balances showed 0. One analyst said, Hyperliquid had the most long liquidations and the least liquidity to match. In simple words, there weren't enough buyers to absorb the selling pressure. When everyone tried to exit at once, the door wasn't big enough. This was no ordinary crash. This was a liquidity death spiral. The smaller the coin, the harder it fell. Tokens that once traded at $50 were now worth $5. Some just disappeared from charts altogether. Behind the scenes, a secret mechanism called ADL, auto-deleveraging, made things even worse. It's designed to protect exchanges during extreme volatility, but instead, it punished traders who were actually winning. Profitable accounts were automatically closed to balance the system. Winners were forced out. Losers were wiped out. Hyperliquid became ground zero of the chaos, a digital battlefield where millions were liquidated and a few lucky entities hiding behind algorithms made a killing. Because while the market screamed red, one mysterious name was quietly making millions, HLP. The Hyperliquid provider, a community vault that acted as the market's undertaker, taking over losing positions, closing trades, and collecting profits while the rest of the world burned. When the smoke cleared, HLP had made over $30 million in a single day. $30 million earned from the ashes of other traders' dreams. The irony? The system that promised decentralization, fairness, and transparency had just rewarded the machines and buried the humans. Altcoins had fallen, exchanges had frozen, and retail traders, the little guys, had learned a brutal truth. In crypto, the smallest coins fall the fastest, and the deepest wounds are always invisible. But the storm wasn't over yet, because while everyone was counting their losses, the real question was, who was really behind the collapse? And who allowed it to happen? When the markets crashed, people thought it was over. Billions lost, traders wiped out, altcoins erased from charts. But deep inside the crypto machine, something darker was happening. A silent system was still running, cold and precise. And it was about to make the chaos even worse. Its name was auto-deleveraging, or ADL, a mechanism designed to protect exchanges when markets go crazy. But that night, it became the very thing that turned panic into catastrophe. Here's how it works. When a trader loses more than their account can handle, the system liquidates their position. But if there are too many losses and not enough funds to cover them, ADL steps in like a digital executioner. It doesn't care if you were winning. It doesn't care if your strategy was perfect. It just starts closing profitable positions to balance the books. Traders across the world suddenly watched their screens flash. Position closed by ADL. Profitable trades vanished in seconds. Accounts that had survived the first crash were now being forcefully unwound. Imagine being right about the market. You predicted the fall, you played smart, and then the system deletes your win because someone else lost too much. That's ADL. It's a failsafe, but for many that night, it felt more like a betrayal. One trader wrote, "My short position was in heavy profit, and then ADL closed me out. I didn't lose the trade. The system stole it." Even professional market makers couldn't escape. Algorithms that managed risk for massive funds suddenly found themselves out of sync, their portfolios imbalanced. As one executive said, ADL doesn't just stop losses, it breaks strategies. And in that chaos, something strange happened. While thousands of individual traders were being liquidated, a mysterious entity called Hyperliquid Provider, HLP, started making money. A lot of it. HLP isn't a person. It's a community vault, an algorithmic pool that steps in to absorb liquidations. When traders lose, HLP takes over their positions and profits when the market keeps falling. During the meltdown, HLP made over $30 million in profit in just one day. $30 million, earned not by predicting the market, but by inheriting other people's losses. As one analyst put it, the system was designed to protect the exchange, but in the process, it punished the people. A DL was supposed to prevent a collapse. Instead, it accelerated it, turning the market into a digital domino chain where one fall triggered another, until everything came crashing down. And when the dust settled, traders realized something chilling. Crypto wasn't as free or decentralized as they thought. Behind the screen, invisible codes had decided their fate. It wasn't the market that destroyed them. It was the mechanism that was built to save them. But as always, in every collapse, someone benefits. So the final question remained, who wrote the code that decides who wins and who loses? While chaos swallowed the crypto world and millions of traders watched their screens bleed red, one silent player was quietly collecting profits. As exchanges melted and portfolios vanished, a single name began to surface among insiders and blockchain analysts. Hyperliquid Provider, or simply HLP, a mysterious community vault that had just made over $30 million in profit during the crash. But here's the twist. HLP didn't bet against anyone. It didn't short the market or predict the fall. It simply stood there, waiting for others to fail. When the cascade of liquidations began, HLP's algorithm stepped in automatically, absorbing the losing positions from traders who were wiped out. And when the market kept dropping, those positions turned into profits. In other words, when millions lost everything, the system itself, not a person, made millions. Some called it genius, others called it exploitation. But one thing was clear, the system had chosen its winner. One analyst said, "It's like a casino that collects chips from busted players and then wins on their behalf, except the casino keeps the winnings." HLP was created to stabilize the market, to make sure exchanges didn't collapse when volatility spiked. But in practice, it acted like a silent predator, feeding on the panic of others. Every liquidation it absorbed was someone's dream erased. Every dollar it earned came from a trader who thought they were safe. As blockchain data started spreading online, traders couldn't believe what they were seeing. $30 million in profit, while the rest of us got liquidated? One post read, it felt less like a free market and more like a digital hierarchy, where the code decides who bleeds and who thrives. Tarun Chitra, a well-known crypto analyst, put it bluntly. There's a question of who should bear the loss, the traders or the exchange, but the algorithm favors the pool, not the people. It was as if the crypto world had been flipped upside down. The decentralized revolution, built on fairness and freedom, now looked eerily similar to the very systems it was meant to replace. Because in the end, the same question echoed across every trading desk and telegram group. If a machine can profit when humans lose, then who really controls the market? And behind that silence, somewhere deep in the digital core of Hyperliquid, the algorithm that made $30 million kept running, cold, efficient, and emotionless, waiting patiently for the next crash and the next opportunity to feed. When the dust finally settled, the crypto world wasn't quiet. The screens were still red, alerts still flashing, and wallets still empty. But the real story was only beginning. The aftermath. While $19 billion had vanished overnight, the ripple effect was just starting to spread. Funds that seemed safe were suddenly exposed. Hedge funds, market makers, and even smaller traders who thought they were conservative, many found themselves caught in the storm. Edward Chin, a CEO of a crypto hedge fund, warned that the real damage could take days, even weeks, to fully surface. And he wasn't exaggerating. Behind closed doors, funds were running risk reports, stress tests, and emergency meetings, trying to figure out who survived, who didn't, and who might collapse next. Some funds had already taken massive hits, and whispers of blow-ups began circulating in private chat rooms. It wasn't just small traders losing sleep. Even seasoned professionals were scrambling to protect what remained of their portfolios. In crypto, one misstep, one algorithm, one unexpected announcement could wipe out months of gains in minutes. And while some investors were quietly selling off to minimize losses, others were preparing for the next wave. Opportunists and algorithmic traders were already analyzing every red candle, every liquidation, every remaining altcoin that had survived, looking for the next chance to turn destruction into profit. The aftershock wasn't just financial, it was psychological. Traders questioned everything, their strategies, their trust in exchanges, and even the promise of decentralization itself. The market had shown them a brutal truth. In crypto, volatility isn't a risk you can predict. It's a force that can strike at any moment, and often when you least expect it. But the biggest lesson? The market is never done. Today's collapse becomes tomorrow's opportunity. Today's loser becomes tomorrow's winner, if you can survive the storm. And survival isn't just about luck, it's about understanding the hidden mechanics, the algorithms, and the invisible hands that control the flow of money. So what comes next? Recovery could take days. Some altcoins might rebound. Bitcoin and Ethereum could stabilize. But one thing is certain, the memory of this sell-off will linger. Traders, funds, and exchanges alike will be watching, calculating, preparing for the next inevitable shakeup. The crypto world never sleeps, and if you blink, you could miss both the danger and the opportunity. If you want to stay ahead of these market shocks and understand the hidden forces shaping your money, don't just watch, subscribe to Hidden Finance File. Here, we uncover the secrets, the winners, and the silent predators behind every market move. Don't miss out. Your next financial insight starts here.